Good evening, everyone. Welcome to our Los Angeles Homebuyer Workshop. Thanks for joining us this evening. We're going to go ahead and get started. I think we're just maybe about a minute or so past the 6 o'clock hour. My name is Jason Maida. It's great to be with you this evening. And probably many of you are joining us tonight because you heard about us through our USC partnership. Really excited to be a strategic partner with USC. And hopefully you guys got a chance to meet with us over at Homecoming. We had a nice booth set up there, and we had a very stressful putting game that you could win a shirt. So hopefully you guys are wearing maybe your shirts for tonight's Home Buyers Workshop. So again, it was great seeing everyone out at Homecoming. So we're going to go ahead and dive in. And tonight's workshop, as we do every week, we teach these workshops with our different partnerships in our communities. And we really encourage these to be interactive sessions. So as we move through tonight's content, really encourage you to ask questions. You can use the chat function on Zoom. Ken and I will be answering questions for you. We'll answer some of those questions on air so we can get a chance to share those answers with the rest of the group. So just a little bit about me. Again, my name is Jason Maida. I'm going to be your facilitator this evening, and we get a chance to teach these workshops every week or so across several different states. And we kind of focus in on what it looks like as future home buyers for us, important things that we want to learn about, like credit, the process of buying, home programs, and assistance programs that can help you as first-time home buyers. So primarily, we're going to be focusing in on first-time buyer resources to help with our first-time buying experience. Okay, here's our talking points for this evening. So we're going to look a little bit at the housing market. A lot going on right now in the market. Seems like there's always something going on, whether it's changes in prices of homes or the interest rate market. We are going to spend some time looking at interest rates and how that can affect our purchasing power. We're going to do a rent versus buying analysis in just a second. We're going to kind of stack up, what does it look like to rent versus what it could be to buy. We're going to take a look at credit, as well as looking at student loans. And then we'll also talk about different loan programs that are available to us as first-time buyers. And then from there, we'll talk about documentation that we typically need as buyers and getting pre-approved for our home financing. We'll also look at some first-time home buyer programs that are available today, but also some programs that are coming in the future here in early 2023. And then finally, we'll wrap up tonight's discussion looking at the loan process. What does it look like, the 6 steps of home buying to go from being pre-approved for your home purchase all the way to the very final stage of getting your keys to your house? So we'll look at all that, including kind of what a personal consultation looks like for you with home buying. All right, so let's first of all talk a little bit about home buying and what it looks like for us in terms of, does it make financial sense for us? Because for some of us, we might not be in that position right now, but we want to kind of plan for the future and kind of build a home buying plan for ourselves. And when you think about purchasing a home, this is probably going to be one of the largest investments you make in your financial futures. This is much different than buying that new car or whatever large expense you're going to have. And for those of you that are joining tonight's class, I mean, you want to understand more about this home buying. What does this look like for us? And this is an asset that we'd be purchasing, of course. So, it affords us the opportunity to be able to create stability in our housing budget. So we're creating sustainable home ownership. This is an asset. So we have the ability to be able to potentially pass along this asset to the heirs of our estate. There's equity that comes with the growth of our value of our home. So whatever our home is worth versus what we owe, that difference is called home equity. And there's still some great tax benefits that come along with owning a home. So a lot of great things that can be afforded with home ownership. Now, as I mentioned earlier, I want to kind of start off tonight's discussion looking at a rent versus buying calculator. And I think as we plan for home ownership, kind of budgeting is going to be one of the most important kind of stops along the way. We really want to kind of figure out what's our budget need to be as we plan for home ownership. And so I'm going to take you through this calculator that we utilize. It is a rent versus buying calculation brought to us by Freddie Mac. And this will kind of show you what a side-by-side comparison looks like of renting versus what it could look like with going down the path of home ownership. So let's go ahead and dive in, take a look at this calculation. And we have some of this kind of already pre-filled out. We're going to assume a monthly rent of $2,500 for our scenario here. And let me see what we're going to put in for our home purchase. We're actually going to, let me tweak a few numbers for us as we kind of go along the path here. Let's go ahead and up our rental amount a bit. I'm going to go ahead and put it to about $3,200 in rent. Now, you'll be able to kind of utilize this calculation yourself. In fact, we're going to send all of our presentation material to you tomorrow morning so you can kind of do your own calculations yourself. But let's assume monthly rent of like $3,200 a month. We're also going to add in monthly renter's insurance that we probably have of $15 a month. And then let's assume that our rental amount goes up by 3% on an annual basis. So when we renew our lease, that it goes up by about 3%. And then from a home price perspective, I'm going to go ahead and change this a bit, make it a little bit higher. Let's just say $650 for now. I know depending on where you want to purchase in the Southern California markets, it's going to look a little bit different for each of you, depending on what type of property you're going to purchase. But let's say $650 is our purchase price. We'll assume the minimum down payment, which is 3%. We're going to talk more about, the loan amounts and required down payments in just a bit when we look at loan programs. But the minimum for a $650 purchase is 3%. We have property taxes on a $650 loan amount. That's going to be, or $650 sales price. That'll be a little bit higher, closer to about $7,250 per year. And then we have homeowners insurance, and homeowners insurance is going to be different than our renter's insurance policy, because homeowners insurance is going to cover that property for theft, vandalism, any type of fire, possibly flood insurance, depending on where your property is located. But we're going to carve out $1,000 in our budget on an annual basis for homeowners insurance. Then we also want to add maintenance for our home. So no longer are we going to be able to contact our landlord when we become homeowners to maybe fix our hot water heater. We got to kind of bake in those expenses into our overall budget. And then we have loan information. So we're going to put in a 30-year fixed mortgage. 30-year fixed mortgage is typically what most first-time home buyers are going to utilize. And then we're going to add an interest rate of 6.125% for an average interest rate. Now, about 3 months ago, interest rates were cresting over 7%. So now we're at 6.1, which is right now we're currently at about a 2-month low in interest rates. So really exciting to see the trend of interest rates kind of leveling out a bit. And then we have origination charges. Those are the closing costs that you would pay for a home purchase through your lender charges. Now, for those of you that are part of our USC alumni network, we do have a discount program available to you. So this origination charge of $1,905 would be reduced by $750 because of our alumni partnership. The next section is called discount points, and that gives buyers the ability to be able to pay additional costs to help bring down their interest rates. And because when we had the higher rate environment, we saw a lot of buyers that were paying additional costs to lower their interest rates. That's changing up a little bit at this point, but that could be an opportunity to help lower the interest rate and create better affordability for you. But there is a cost for lowering that interest rate. And like I said, that's called discount points. Usually 1 point is the equivalent of 1% of your loan amount. So if I'm going to finance $600,000, 1 point would be 1% or $6,000 that would help lower that interest rate, generally about 0.25%. So instead of maybe 6.125%, I'm going to be able to get a 5.875% rate. The next section is called other settlement charges. Those are also known as closing costs, and those can vary based upon what you negotiate with the seller. Usually closing costs in total between lender costs, some of our prepaid items, anything with around title and escrow can be up towards of 2 to 3% of our sales price. So I'm going to go ahead and change this amount just a bit. Let's put it closer to about maybe $12,000. I think that'll give us a kind of a better idea of what closing costs will look like. When we think about saving for a home, we're going to have two kind of components to saving. There's going to be the savings for our down payment. There's also going to be the savings for our closing costs. We're going to talk about the housing market in just a bit. And I think what's important to know that in today's market, sellers are a little bit more, I guess, willing to negotiate, especially when it comes to not only price, but closing costs. In some cases, sellers will split those closing costs with you 50-50. In some cases, sellers will help provide a credit towards your closing costs. So there's a variety of different ways that those closing costs can be structured. Now, if we were to look back 6 or 7 months ago in the market, we were seeing sellers that could get top price for their home, and they really weren't in a position where they had to pay for much of closing costs. So buyers would generally say, hey, I'm going to overbid for your house, plus I'm going to pay all the closing costs. And that, of course, was in a different interest rate environment. So what we're seeing today is those interest rates, with the rise that we've experienced over the last 4 to 5 months, have really kind of obviously impacted the housing market. And we're going to look at that in just a second. The last tab I want to look at is the other assumptions. So we're going to assume our house goes up in value about 3% annually, or 3% over time of ownership. And we're going to say that we're going to have ownership for about 7 years. Okay. We have the selling cost of our home. And when we think about selling costs, that's going to be for the realtor commissions to sell the home. As a seller, you're going to have to pay for the buyer's agent as well as the seller's agent, which represents you, as well as closing costs. Now, as a first-time home or as a buyer in general, you don't have to pay the realtor commissions. So when you have a realtor that represents you, they will earn commissions from the sale of that home, but that's not going to be your responsibility as part of your closing costs. Last two sections are state and federal taxes. We're going to assume a 33.8% tax rate and then a savings rate of 1%. So what this calculator comes back is that and says, if I continue to rent, now I do know my rent's going to be a lot cheaper, right? It's $3,200 a month. My mortgage payment's going to be closer to $5,200 a month, but my total cost opportunity over 7 years is about $65,000. So when I factor in my rent going up 3% every year over the next 7 years, versus my tax savings, my equity appreciation in my home, I have about a $65,000 opportunity of buying versus renting. Now, I know that math will change a little bit, especially if you're going to buy a higher priced home in the market, or if you're paying a lot less in rent, those numbers will change a little bit. But this kind of gives you a little bit of a guideline when it comes to kind of looking at your budget and see what it could look like in my home buying future. Okay, so again, I'm going to send you all the material from tonight's presentation. So that link to the rent versus buying calculator will be included as well. Okay, let's go ahead and continue on. Now I want to talk to you a little bit about the housing market. I know I kind of alluded to it a little bit earlier, but this is a great graph that kind of shows you what's going on with the housing market, and it really correlates with what we've seen going on in the interest rate market. So you're seeing homes on market, the median days on market's like 49 days. As opposed to what we saw 6 months ago, we probably saw somewhere in the neighborhood of 20 to 25 days on market. And then you're seeing prices come down quite a bit. So we started first quarter, 1.1 million in home price, median home price, where that has now slipped down to closer to 900,000 median sales price. So, the market, the shape of the market, the dynamics has definitely changed up quite a bit. And so we are seeing prices come down. Now, where does that bottom go? We really don't know at this point. If I look at interest rates today, interest rates are starting to level out. And so, as I mentioned to you earlier, interest rates are at 6.1%. So we've kind of seen rates go rocket up, and then now they're kind of tilting up. And if we were to kind of take this interest rate analysis that we have here, and this blue line represents the 30-year fixed, it kind of would go like this and then maybe kind of level out a little bit. So, and there is discussions or talks, and many of you may be charting these other economic indicators, that we could be slipping into a recession, which a recession would generally lead to lower interest rates, but it also will probably push more buyers into the market, create a little bit more of a competitive market than what we have today, because obviously homes are staying on the market much longer, not as many buyers in the population looking. And so, we'll see what, things happen over the course of, 2023. I think the first quarter of 2023 will be a really good indicator of what the rest of the year looks like. I know we have a lot of interested buyers that are going out into the market because they're starting to see sales prices slip quite a bit. Now, if interest rates can cooperate and we can maybe stay in that 6 to maybe mid 5% level, I think it's going to be a much better opportunity for buyers, because we did see many buyers being impacted by rates cresting over that 7% level. All right, and then the next thing I just want to kind of highlight here is just the 15-year fixed, because the 15-year fixed is not probably something that most of our first-time buyers are going to take advantage of, because it will raise the payments up pretty significantly. But the lower term we have on a mortgage will also give us lower interest rate opportunities. So let's take a look at some of the characteristics of what makes up an interest rate. So the first thing is credit eligibility. Generally, if we have a 740 credit score or higher, we'll be able to get the best available interest rates. Loan products. So whether I'm doing an FHA loan or a conventional loan, maybe a jumbo loan, that could change my interest rate. How much I finance, how much I put for my down payment, and then the cost that I'm going to pay for my mortgage. We talked a little bit about it earlier. Discount points will influence my interest rate that I have. So if I decide I want to pay points, that can help bring down my interest rate. And then I just mentioned it just a minute ago, which was around term. So the lower term I have on a mortgage, the cheaper my interest rate can be as well. And what our role is in the process is to kind of design financing options that best fit your financial goals, right? So whether it's a 15-year mortgage or a 20-year mortgage, we want to put those options together that are going to help you accomplish your homeownership goals. Now, probably the biggest thing that comes with kind of designing home buying plans is really kind of two things that we've got to talk through is around credit, whether it's obligations or credit utilization or having to optimize our credit score, but it's also down payment. And we're going to talk about down payment in just a bit, because those are kind of the two possible hurdles for most of our first-time buyers. So in our workshops, we really like to spend some time talking a little bit about credit, give you some, kind of more insight as to how to help improve your credit score with some helpful tips and some things that we look for as lenders. So let's first look at the FICO score calculation and how the weighting looks for credit scores. So 15% of it's going to be how long I've had credit. So the longer I've had credit, the more mature my credit file is, the higher my credit score could potentially be. 20% is going to be how much credit I have in use, or sorry, how long I've had credit in use. So if I'm establishing new accounts, that's going to hurt my credit. Or if I'm trying to access accounts by new inquiries, that's also going to hurt my credit. So those are going to be what we call hard inquiries. There's a difference in inquiries between hard and soft inquiries. When we start our pre-approval process here with our team, we start with a soft inquiry. Most lenders will do hard inquiries. Now, there is credit rules in place that if you have a hard inquiry, you have a 30-day window of time to shop around with as many lenders as you want. So once you have that inquiry at day one, you have 30 days to shop around with as many different lenders as you want. The next section is amount owed. That's 30%, or what we call utilization. And that's really kind of what impacts our clients the most. So when we look at utilization, it's your credit limits of your revolving debts versus your credit balances. So let's say I have $10,000 in credit limits and my balances are $5,000. That means I'm at 50% utilization. If you're hovering around that 60 to 70% utilization, our first step goal is going to be to at least get to below 50%. And if you're trying to just optimize your credit score and you really want to get to the best possible level of credit, I would encourage you to get to below 10% utilization. Now, here's a quick tip to help you with kind of managing utilization. Tonight, if you have an opportunity, take a look at the billing cycle date on your credit card, because the billing cycle date is the date at which the credit card issuer sends out the data on your credit card to the credit agencies. So if your billing date is the 20th, but your due date's on the 4th, even though you're paying off your credit card on the 4th, or maybe paying it down on the 4th, whatever that balance is on the 20th is still being pushed out to the agencies and probably impacting your overall credit utilization. So I'd encourage you, if you're managing your credit balances and you want to get that optimal credit score, try to pay down or pay off your credit balances before the end of that billing cycle. Okay, and that'll really help that 30% component with your FICO score. Last section is going to be payment history. That's going to be, how I paid my bills. If you've had any late payments, past challenges, they rate delinquencies in 30-day lates, 60-day lates, and 90+ days delinquent. Okay. The higher your rate of delinquency, the more impacted your credit score will be. Typically, late payments in the last 12 to 24 months are going to most impact your credit score. I'll show you a matrix just in a second, which shows you kind of how long things will kind of stay on your credit report. A couple other things to think about is with loan programs, there's minimum credit scores for each loan program. We're going to talk about those in just a minute, but FHA loans have a minimum credit score of 580, conventional loan it's 620, VA loan it's 620, and then for the CalHFA assistance programs, which we're going to share with you in just a minute, is 640 for an FHA loan, 680 for a conventional loan. Last thing I want to share with you in the credit spectrum is around how lenders will evaluate your credit scores. So there's 3 different credit scores, or 3 different agencies that report the credit scores. So there's TransUnion, Equifax, and Experian. As lenders, we take the middle credit score of all 3 bureaus. So if you're at 760 as your highest score, and then your middle score is 740, and your lowest score is 720, we're going to use the 740 score when it comes to qualifying. Now, if I have a partner that's going to apply with me and their credit score is 740, 720, and 700, then the 720 score is going to be the middle score we use for qualifying. So we always take the lowest middle score between both borrowers. Okay, and that's kind of pretty standard with most products. And then finally, with credit, account closure can also impact your credit score. So what that means is if I decide to close out a revolving line of credit, once I've closed out that account, all the great history that I've had in the past. So if I've had a credit card for 10 years and then I close out that account because I did a balance transfer to a different credit card issuer, all that great credit history will be lost from the credit model. So just, be careful when you start moving or doing balance transfers. Make sure that it's going to give you a better opportunity with your credit score, because certainly closing out your card on the old account could negatively impact your score. Speaking of negative items on your credit report, here's how long those items will stay with you on your credit report. So hard inquiries will be on the report for 2 years. I think the impact will be in the most recent 6 months to a year will impact your credit score. Late payments, collections, those will all be on for 7 years. Bankruptcies, 10 years, and then student loans, if they're delinquent federal student loans, they're probably in a collection status. So those will remain on your credit report indefinitely. With student loans, I know there's legislation right now to have forgiveness with student loans for federal student loan debt. And hopefully that does come through, and we're looking forward to that for our prospective home buyers, just to be able to create better affordability. So if you have less debt, that helps you to qualify for your financing. But in the now, we do have to count a minimum student loan payment when it comes to getting pre-approved for your financing. If you're on an income-based repayment amount and you were on an IBR payment prior to the pandemic, that's the amount that we're going to use for your qualifying. But many of us have 0 payments right now, and I think they just maybe extended the forbearance longer. Even though we're in forbearance, we still have to count a minimum payment against you for qualifying. So if you're utilizing an FHA loan for your financing, we're going to by default count 0.5% of the balance as the monthly payment. If it's a conventional loan, it's 1%. But like I said earlier, if you're in an income-based repayment amount, then we're going to use the income-based repayment as the payment calculation for qualifying. So for example, if I have $75,000 in student loan debt and it's, on an income-based repayment amount of say $250 a month, that's the amount that I would use to qualify, because on an FHA loan, the default would be $375 if I'm not on an IBR payment, but on a conventional loan, it'd be $750. So those IBR payments can be pretty important for helping our buyers with their qualifying. Now, if you're back in school and you have like a deferment because the loans are deferred while you're in school, we still have to count a minimum payment. Now, if it's a 0 payment and that's what your IBR payment was, that's the amount we can use for a conventional loan. FHA will require you to have a minimum payment, though. It cannot be at least 0. It has to be more than 0. Okay, any questions on student loans? Because that comes up quite a bit during our sessions. Okay, all right. And we can always backtrack if you have any other questions on some of the other topics that we've gone through so far. Now, I want to kind of talk to you a little bit about loan programs. These are kind of 5 of the core loan programs that we teach on during our workshops. And most first-time buyers are going to utilize the conventional loan or an FHA loan. But there's a variety of different products that are available to buyers. But these are the kind of the core products that we look at. So we have conventional loans, FHA loans, VA loans for our veterans that have served and have VA eligibility. There's the USDA loan. That's for a U.S. Department of Agricultural loan. That's more of our rural area loans, area properties. And then there's jumbo loans, which usually require 10 to 15% down. Now, just recently, Fannie Mae and Freddie Mac announced higher loan limits for those agency products. And that's kind of a big deal, especially in our higher market area, especially like Southern California. So what that means for you as a potential buyer is we can finance all the way up to $726,200 in loan amount, and the minimum down payment is 3%. Now, once we go beyond $726,200, we get into a space called high balance, and that goes up to $189,300. So from $726,200 to $189,300, there's an area called high balance. that does require you to put a minimum of 5% down for either a first-time buyer or a second-time buyer. But those limits are higher than they were the previous year. They're over $100,000 higher than what we saw in 2022. So those limits take effect immediately. And then for some of our clients that are utilizing first-time buyer programs, like assistance programs, those will be available on January 1st, 2023. So that's really good news there, especially to address some of the affordability issues, or not necessarily affordability, but just financing issues that we have, especially in some of our high cost of living areas. Now, if you go beyond this $1,089,000 finance figure, then we would have to go into a jumbo loan product. And for first-time buyers, it makes it a little bit more difficult because it's a 10 to 15% minimum down payment requirement. On top of that, we would have closing costs that we'd have to save up for. Plus, there's a thing called reserves on jumbo loans that requires you to have generally 12 months worth of your monthly payment in asset accounts. So if I have a $6,000 monthly payment, I would need roughly about $72,000 in additional assets. Now, they can take the shape of a 401k or a 403b, or obviously in checking your savings accounts, but that can tend to be a little challenging for some of our buyers. So that's why we see most first-time buyers going into the conventional or FHA products. So on a conventional loan, so when you think about Fannie Mae, Freddie Mac, that's the type of conventional loan we're speaking of. Like I said earlier, it's a 3% down minimum requirement, usually a minimum credit score of 620. For our FHA loans, and when we think about FHA, that stands for Federal Housing Administration. It's not just for first-time buyers. It can be second and third-time buyers. FHA is going to be a little more lenient than it as opposed to a conventional loan. It does have a minimum down payment of 3.5% down, regardless of where you're at, whether it's a conforming limit or a high balance loan. So we can go all the way up to $1,089,300 and still have that minimum down payment of 3.5%. Now, these loan limits do vary by geography. So if you happen to be joining us from Riverside County or San Bernardino County, those limits are going to be a bit lower. I think we may have those on the next page. If not, we can get those to you. The maximum loan limit in those areas is $726,200. So they'll fall within the conforming limits. And then for our VA loans, for our veterans that have eligibility for the VA loan, that's a great product because it's a zero down payment option. You can actually go beyond $1 million on a VA loan. And we can kind of go through those options for our veterans that are eligible for those programs. Now, I want to kind of switch gears now and talk a little bit about PMI, which is a hot topic for buyers, because when you think about PMI, first of all, it stands for private mortgage insurance, comes into play on conventional FHA loans. Conventional loans, when we put less than 20% down, FHA loans, you're going to have PMI regardless of the amount of down payment. For conventional loans, there's a few different payment options for PMI. You can pay it on a monthly basis, so it's incorporated into your monthly payment. There's split MI, and that's where you pay some of it up front, you pay some of it on a monthly basis. There's single premium MI, and that's where you basically buy out the mortgage insurance for the life of the loan. And then there's also lender paid mortgage insurance. And that's where you go from, let's say I had a 6.1% rate, but then I want to buy out the mortgage insurance. So I decide to take a higher interest rate. That's called lender paid mortgage insurance. So let's say I jump my rate from 6.1 to 6.75, and that allows me to buy out the interest or buy out the mortgage insurance. Most clients are going to utilize the monthly mortgage insurance. And the reason why is because it has a cancellation option. Generally, when you have 2 years in the home and 22% equity in that home, you can apply to have the mortgage insurance canceled. Now, with PMI, there's a few different characteristics that will make up the premium for PMI. There's the credit score, there's how much you finance, and then what your down payment is. So the more money I put down, the less I finance, the higher my credit score is, the cheaper my mortgage insurance is going to be. Let's take a look at a PMI example, as you can see down at the bottom of the slide here. So let's say I finance $450,000 and I have a credit score of 740 and I'm putting 3% down. My PMI is going to be about $183 a month. Okay, so pretty reasonable. And if I elevate that down payment, then that mortgage insurance will start to become lower. Now, if you're doing some home searches on Zillow or maybe Redfin, when you run calculators on those sites, they're going to have much higher premiums. It's just because they're not calibrated with the characteristics of the PMI criteria. And then for FHA loans, FHA, regardless of your level of down payment, you're going to have mortgage insurance. So if you put 3.5% down, Generally, you're going to have mortgage insurance that's the equivalent of 0.85% of your loan amount. And then there's also upfront mortgage insurance with FHA. It's usually 1.75% of your loan amount. Now that gets added into your amount finance, but it's on top of the base loan amount. And with FHA mortgage insurance, you cannot cancel the mortgage insurance unless you go into a refinance situation. So it'll be for the full 30-year term of the loan. So now, if we take the same loan amount of $450,000 and we look at it on an FHA loan, the monthly PMI is going to be about $324 a month. Plus, we'll have to add on the $78.75 for PMI. Okay, I think we had a hand raised, if I'm not mistaken. And I think we just came. Okay, so Tara had a quick question. So how long do you pay PMI for it if it's monthly? So the monthly PMI will be at minimum for 2 years. And then once I have 2 years in my original loan and I have 22% equity in my home, then I can contact my loan servicer to potentially cancel that mortgage insurance. Now, when you look at the side-by-side comparison of conventional loan versus FHA, you may say, well, why would I ever choose like FHA? Because the premium's $140 a month more. It has the upfront mortgage insurance. And so you may say that just doesn't make sense. I want to go with a conventional loan. Well, the reason why we may consider FHA over conventional is just because of the overall qualifying. FHA is a little more lenient with a thing called debt to income ratio. As you heard earlier, the credit score minimum is 580 versus 620. If you've had some past, maybe late payments or maybe a past bankruptcy that's less than 4 years old, FHA would be a little more lenient and allow some qualifying, where conventional, that would be a little more restrictive. So as we build home buying plans for our first-time home buyers, we'll kind of see what the best fit for you is and kind of give our expertise. But that's the reason why maybe a buyer might choose FHA over conventional or vice versa. Okay, now we want to talk a little bit about income qualifying and documentation needed as a home buyer taking those next steps in home ownership. So generally, if I'm a W-2 wage earner, we're going to need to provide the last 2 years of taxes, the last 30 days of pay stubs, and then a verification of employment. So that's usually what we're going to need there. Now, for self-employed, it's going to be a little bit more intensive because we're going to need the last 2 years of taxes. We have to have filed tax years for the business, profit and loss statement, and usually a balance sheet. And then we have to verify the business in some way, shape, or form. That's going to be usually with a business license or a CPA letter. So that's kind of what the documentation looks like. Now, a couple different scenarios that clients will present us with, and I think this will be helpful for you to know. And I guess they're more kind of misconceptions. What we do hear from buyers is, their misconception is that I have to have 2 years on my job to apply for a mortgage. And that's not the case. You actually need 2 years of overall work history. If you don't have that, let's say I just graduated from USC and I'm just starting my career, as long as I can show that I had previous 2 years at least of education. So let's say I had a 4-year degree. If I have that, and then now I'm working in my field of study, that would satisfy the 2-year requirement. If I've been working and I'm only 1 month on the job, but previously I had 2 years on my other job, that would satisfy the 2-year requirement. Now, if you are in a part-time job, or let's say you have dual employment, let's say a part-time job, in order to use that income, we do have to have at least 2 years on the part-time job. And if you're working dual income, so let's say I'm in the healthcare industry and I work at one clinic here for 20 hours a week, 30 hours at another clinic. If that's the case, then I do have to show that I've held down the dual employment for at least 2 years. Other scenarios that we hear from our clients is that if I have a full-time job, but let's say I'm driving for Uber on the side, I'm making some extra money. If I want to count the Uber income, that income is going to show up under Schedule C income, as sole proprietor income on my tax returns. So as long as I've been showing a full-time job plus doing the driving for 2 years, then I can potentially count that income for my qualifying. Next thing that comes up with looking at income scenarios for our clients is if I have a new job and I'm really trying to get pre-approved for my home. So let's say I have a job that I'm going to start on January 1st, but I really want to get pre-approved now because I want to buy a house in the area that I'm going to move to in January. you could be potentially qualified utilizing an executed offer letter for your new job. And as long as you're going to receive your first paycheck before your first mortgage payment is due, then that new income source could be utilized. Okay. Any other questions around income? One of the things that comes up, just as kind of thinking out loud here, when we work with clients and they want to include income from partners or spouses, in order to include income from any other sources, like a partner, for example, that's living with you, they also have to be on the application. So only income that can be considered is those that are actually on the application. Okay, so it's kind of sticking with the theme of income. Now we're going to do a quick assessment of looking at our income versus our obligations. We call that the debt to income ratio. And that gives us as lenders a guideline of qualifying. Now, it's not an indicator of affordability. That's going to come with our consultation conversation because we're going to talk about budgeting during that session. Debt to income ratio is going to take your gross monthly wages versus some of the debts that I'm paying out, maybe a personal loan, credit card, student loans, car loan, as well as my new mortgage. I'll show you what the formula looks like, but ultimately we don't want those items exceeding more than 43 to 45% of your pre-tax income. In some cases, we can go up to 49 to 50% debt to income ratio, but ideally we want to keep around 43 to 45. Here's what that formula looks like. So we take the principal and interest, the property taxes and homeowners insurance of the new loan or the new property that you're purchasing. We take the PMI if we're putting less than 20% down, or the private mortgage insurance. If I'm buying a condo, maybe I'm buying a townhouse, maybe some single family homes, you'll probably have HOA or homeowners association dues. If we were to buy a property that had a $2,500 per month budget, and then our other debts were $500 a month, that's $3,000 in obligations, versus what my pre-tax income is of $8,500, I'm probably around a 35.2% debt to income ratio. And that would be well within qualifying. Most of our first-time buyers feel really good if their debt to income ratio is around 33 to 36%. But again, it's not really our leading indicator of affordability. That's going to come with kind of doing an assessment of what your overall debts look like and kind of having that conversation of where you feel really comfortable with your budget. Again, most first-time buyers feel really good around that 33 to 36% debt to income ratio. Okay, the last stop in our conversation around building our home buying plan is going to be around down payment or the assets that we need for purchasing a home. I'm just going to quickly go through the documentation needed for assets, and then we're going to spend some time looking at first-time home buyer programs. Like I said, there's usually kind of two things that maybe get in the way of home ownership. It could be credit challenges or obligations, but then the other side of it's going to be maybe assets or just having enough savings because we're just getting our financial future started. So let's first of all talk about kind of some of the documentation needed, and then we'll kind of transition into some of the assistance programs available to us as first-time buyers. So pretty easy with documentation. If we have our money sitting in our checking or savings account, we're going to generally want to see the last 2 months of statements. Any large deposits, transfers, those are all going to have to be kind of paper trailed. Cash deposits can't be used. So if you've been saving up a bunch of money or got a gift from the family member and it was cash, it does have to be paper trailed back to the institution that it came from. So just something to be aware of as you're saving up for your home purchase. Retirement accounts can potentially be used, 401ks, 403bs, even IRAs. If you're going to access an IRA account or maybe even withdraw from a 403b or 401k, talk to your financial advisor, maybe your tax advisor, because obviously you don't want to create any type of tax consequence or lose money in the market. Usually with 401ks and 403bs, however, you'll be able to take loans out against those. Those loans that you take out because you're borrowing money against your own asset, those aren't impacting your debt to income ratio. Okay, we had a quick question that came in. Let me just read it really quick. So the question was, when we're looking at the asset accounts, personal checking and savings accounts, are we also looking at business checking and savings accounts? So that could be a yes, depends on if you're going to utilize the business account as a form of asset for your down payment. If you're not, then it's not necessary. What we would want to do if you are using a business account, we have to make sure that liquidating some of the business funds isn't going to negatively impact the business. So there'll be like a liquidation test for the business. All right, the last thing I want to kind of share with you on assets is around gift funds, and that seems to be pretty popular for our first-time home buyers. So if we have family members that want to help out with your home purchase, they can absolutely do that. There's a process for going through that. For the gift funds, they have to be transferred either to you or to the escrow company, and we have to document that. Usually the donor is going to have to complete a gift letter. They may have to show the asset account that they're pulling the money from, and then show some type of transfer of those funds. Now, different than other maybe assets that you have, gift funds do not have to be seasoned, meaning a seasoning requirement usually is 60 days. So if I deposit money to an account and it hasn't, I can't paper trail it, then it has to season out 60 days. But with gift funds, they do not have to be seasoned. So a donor can help you out with your home purchase right away. Okay, so let's kind of stick with the theme of savings and assets needed for your home purchase by now looking at down payment assistance programs. And we're really thrilled to be a partner with CalHFA. We're the leading provider of first-time homebuyer programs in the state of California. And CalHFA stands for the California Housing Finance Agency. And this agency is designed to help low to moderate income families achieve home ownership in California. There's some exciting new programs that are forthcoming with CalHFA. We actually had just a program that just terminated last week because we ran out of funds for that program. That was called the Equity Builder Program. But we have a new program coming out in early Q1 called the California Dream for All, which I'll talk about in just a second. But today we still have what we call the My Home Assistance Program, and that provides up to 3% on a conventional loan in a down payment assistance. And that's 3% of your purchase price. And then on a CalHFA FHA loan, you can get up to 3.5% of your sales price in down payment assistance. It is a low interest loan at 1%, but it does not have to be paid back to the state until you either sell the home or if you refinance in the future. So that's a really cool program that's available today for our first-time buyers. Now, we're anticipating the launch of the California Dream program in early Q1 of 2023. The California Dream for All program is a program that I have the opportunity to be part of the project team with, and it, in essence, provides up to 20% of the sales price in down payment assistance for a future home buyer. Now, this is a little bit different than other programs because the 20% does require to be paid back when you sell the home or if you refinance, but it also has what we call an equity share agreement. What that equity share agreement says is that if your home appreciates, let's say $100,000 over the course of 7 years, 20% of that equity share would be repaid back to the state. So you would pay back your 20% that you got in assistance plus the other 20% from the equity share. There is going to be reduced equity share agreements for some of our low-income housing clients that make less than 80% of the median income. But if you think about the opportunity to be able to put 20% down, you are able to finance less, you have no mortgage insurance. So it's a huge opportunity for our first-time home buyers. And when we look at these higher income limits, they're going to now be instituted for 2023, really presents a huge opportunity for future home buyers. CalHFA income limits are usually 150% of the median income for the county. So as you can see here, Los Angeles is 180, Orange County is 235, a little bit lower in some of our outlying counties like Riverside and San Bernardino, but most first-time buyer programs will be at 80% of the median income. So they're just a lot more lenient. When we look a little closer at some of these assistance programs, the My Home Assistance, as you heard earlier, it's 3% assistance for a conventional loan, 3.5% for FHA. It's a low interest loan at 1%, does not need to be paid back until you sell or refinance. The other program that's available for closing cost assistance is called ZIP, or Zero Interest Program. That is a zero interest loan that is the equivalent of 2% of your loan amount for one option, or 3% of your loan amount. If you do elect the ZIP assistance program, it does increase the interest rate. So we have to kind of figure out if that trade-off is worth it for you as a first-time home buyer. That's something we'll kind of talk through as part of your home buying plan during a consultation. Let's take a look at a conventional scenario, so just so you can get a sense of what like the out-of-pocket expense would look like. So let's say I bought a $500,000 house. Now we know the minimum down payment is 3% or $15,000, but I'm also going to need 2 to 3% of my sales price in closing cost assistance. So that's anywhere between $10,000 to $15,000. So I'm probably going to need about $25,000 to $30,000 to be able to purchase my $500,000 home. Now, That may be totally reasonable for some of our guests in tonight's class, but for others, it might be a little bit challenging. And that's where the CalHFA assistants can come on board and help out with that. So let's say I add on the My Home Assistance. Now I can take that $15,000, add it to my out-of-pocket expense. And now instead of 25 to 30, now I may be looking at maybe what, 10 to 15,000 out of pocket. So a little bit more reasonable. If that number is still a little bit of a stretch, then we can look at possibly adding the ZIP assistance, where it's 2 to 3% of your loan amount. Not in this scenario, $9,700 to $14,000 assistance. And now I can reduce that out of pocket even further. So there's all these different combinations that we can look at to be able to help our first time buyers to be able to kind of reduce that overall out of pocket expense. Now, with the CalHFA assistance program, there are more borrower eligibility requirements. It's a minimum credit score of 640 for an FHA loan, 680 for a conventional loan. The debt to income ratio that we talked about earlier goes up to 45% as a standard debt to income ratio. But if I have a 700 credit score or higher, I could potentially go up all the way up to 50% debt to income ratio. Different from most first time buyer programs and below market opportunities in some of our communities, where you're able to purchase homes below market. Those will look at the household size and the income for that household. The programs with CalHFA only look at the applicant income. And why that's super important is because if I live in a dual income household, and let's say I make 100,000 and my spouse makes 100,000, well, combined we make 200. And if I'm trying to buy in LA County, that's going to take me over the 180 limit. But if we just apply in just my name, then we stay within that income limit and be potentially eligible for these assistance programs. So that's a great opportunity for dual income households. Now, a first-time home buyer is someone that hasn't owned in the last 3 years. Okay, so you could have owned a house in 2010 and sold it in 2015. Now you're still a first-time home buyer in 2022. This program is eligible for single-family homes. You can buy new construction, condos, townhouses. I allude to the BMR homes or below market homes. Those are all eligible with CalHFA. Manufactured homes are eligible, but gets a little tricky with manufactured homes because they do have to be on land that is owned. So it can't be like in a mobile home park or anything like that. Okay, now let's look at the buying process. We've created this 6 steps of home buying so you can get a sense of what does it look like to get pre-approved for a house, start my house hunting, and then get to a place where now I'm getting the keys to my house. So the first step is pre-approval. Now, pre-approval comes from, or the output of a consultation. The consultation is a one-on-one session with me. I'll talk a little bit more about that in just a minute. The pre-approval is a certificate that gets presented to the seller to show that you have valid financing. Usually it's good for 60 days, but if your home shopping process takes longer, we can always recertify your pre-approval. So, you may take a year or two to find the right house, and at any time we can always recertify. At that, you won't have to necessarily reapply again. We'll just have to get updated documents from you. So we always encourage clients to get pre-approved as early as possible, just so we can help set some goals for you. Step 2 is going to be house hunting, and that's where you get a chance to not only do an online search, but maybe perhaps partner with a realtor to take you through the home shopping process. We have a fantastic network of preferred realtors that we work with that understand first-time buyer programs. But whoever you decide to use as a resource, they'll be kind of an expert in the market to show you homes that fit your needs. And your pre-approval letter, as you maybe make offers on a home, can be updated to match your purchase price of the house, as long as it's within your qualifying. So let's say, for example, I get qualified for that $500,000 house, but I fall in love with the house for $475,000. You may want us to adjust down your pre-approval to $475,000 to have that match your offer price that your realtor puts together for you. Okay, so let's say we find that right house, we make an offer, the offer gets accepted. And by the way, in this market right now, we're seeing a lot more offers get accepted. So really encouraging for our first-time buyers. So that's a big deal. But let's say your offer gets accepted. Now we're going to go to step 3, which means we've entered the escrow process. Within 24 hours of that acceptance, we're going to give you a call, say congratulations, and kind of give you kind of a high level of what the next step looks like in the process, and schedule you for your follow-up consultation. Now, per your purchase agreement, you're going to have to make your earnest money deposit within 2 to 3 days of receiving an accepted offer. I'm going to talk to you a little bit about that in just a second. So we're going to get you scheduled for your follow-up consultation. The follow-up consultation is going to occur within about 3 days of your accepted offer. During that follow-up, we're going to go through your interest rate options, your out-of-pocket expense, your monthly payment. Make sure you feel comfortable with kind of this comprehensive view of your home financing. We're also going to order an appraisal of the property because we want to make sure your house is worth what you're buying it for. And then within 24 to 72 hours of that follow-up consultation, you're going to receive disclosures. They're going to be sent to you that highlights all the aspects of your financing. Now, the earnest money deposit is something that's going to be required to be paid out of pocket within 2 to 3 days of your accepted offer. It's usually 1 to 2% of your purchase price, and those funds will count towards your total out-of-pocket expense. Okay, so if you're buying that $500,000 house and you had a 1% earnest money deposit requirement, that would be basically a $5,000 deposit that would count towards your total out-of-pocket expense. Now, the earnest money deposit is retained in an escrow account, and the seller doesn't have access to those funds because the contract is protected by what we call the contingency, or you're protected within the contract by a contingency period. Now, when we're in this crazy market 6-7 months ago, it was very difficult to get contingencies with sellers because the sellers kind of had the upper hand and it was a seller's market. But now buyers can set contingencies in their contract that are more reasonable for them and give them just the opportunity to do their due diligence on the property. And again, the contingencies protect that deposit. So a contingency will be for your appraisal to ensure that your house is worth what you're buying it for. Could be inspections that your realtor sets up for you, and then loan contingency that ensures that you have your home financing set up and approved. Usually those contingencies are within the first 14 to 17 days of your contract. Okay, so step 4 is going to take us to processing and underwriting. That's where we do the administrative tasks of your loan. We're going to verify your assets. We'll verify employment, make sure we have all the documentation we need to put together your financing. By that time, your interest rate is probably locked because of the kind of the volatility in the market. And then we'll submit everything to our underwriting team. And the underwriter's job is to go through all of your documents to make sure that you meet all the qualifying parameters and issue a loan approval. And that loan approval will take us to step 5 in the process. And at that point, we're about probably 3/4 of the way through the process. And at the end of the contingency period as well, too. If everything has checked out with your inspections, the home is worth what you expect it to be, and of course your loan is approved, then you can remove your contingency. That tells the seller that you've done all your kind of inspections, your due diligence, so to speak, and now that you're ready to move forward in the process. Now, once you've removed contingency, now you're kind of pushing that deposit all in. So if you decided to cancel a couple days later, then you could risk losing your deposit. So you want to be really careful that this is kind of the right step for you. At step 5, we're also going to issue to you a final closing disclosure. It gives you a 3-day cooling off period on your financing, shows you what your estimated cash to close is at again, because everything kind of gets trued up at step 5. After that 3-day period has elapsed on your cooling off period, then we move to step 6, and that's called closing the loan. And that's where you're going to sign final documents in person with a public notary. That process takes about an hour or so. After you've completed that, then you'll wire in any funds that you're responsible for your transaction. So now you have your deposit plus your additional funds. That money is all reconciled by the escrow officer. And then we'll also wire in the funds for your financing. That money gets reconciled again with the escrow officer to ensure the seller is receiving the funds that they expect. You're contributing what you're supposed to as a buyer. After all that is all balanced, then the escrow officer will release documents to be recorded with the county recorder's office. And they record a grant deed, which transfers ownership to you. And they also record a deed of trust, which is your agreement to repay the loan. For our clients that are buying their homes in the month of December, so they're going to have keys this month, their first mortgage payment is not due until February 1st. The reason why that is because mortgage interest is always paid a month behind. So when you close your home financing, we actually collect interest for all the remaining days of the month. So the client I just spoke to before tonight's workshop, she's getting her keys on December 27th. We're going to collect 4 days of interest for the remaining days of December, but then she won't have to make a first mortgage payment until February 1st. Okay. And once we've wired in the funds for the financing and we've recorded everything, that is the confirmation the transaction has been completed, and now you become the official owner of the property. And that's when you get a chance to celebrate, high five, And this is a big accomplishment. Like I kind of kicked off our meeting earlier. This is going to be probably one of the largest investments you make in your lifetime, or at least your near-term financial picture. So we really want to celebrate with you on that too. So your realtor will generally be connecting with you to get your keys to your property once we have that confirmation of those recordings. Now, you've heard me talk a little bit about consultations. This is kind of the first step in the process. We really encourage you to meet up with us for one of those video consultations. That's about a 30-minute session with me that allows you to kind of build that comprehensive home buying plan. Before we set that video consultation, you would submit an online application, you would upload some documents, and then of course we would get the video consultation scheduled. As I mentioned earlier, when we were talking a little bit about credit, we only do a soft credit check, so that doesn't impact your score when we do one of these consultations. And you can see kind of the required documents here, as well as the links on our slides here to be able to schedule one of those consultations. Now, if you just have some follow-up questions from tonight's session and you just want to know a little bit more information, or maybe you have a scenario you want to run by me, really encourage you to do an intro call, and then myself or one of our team members can help answer any of those follow-up questions for you. Here's what a consultation looks like. So again, it's a comprehensive home buying plan. We're going to look at budgeting, kind of where do I want to purchase? What does that look like from a sales price perspective, interest rate options, out-of-pocket expense, just so you can have a good idea of what home buying could look like for you. We have some fantastic resources, including our APM mobile app. You can download it through Android or Apple, and allows you to do payment calculations, follow the progress of your loan. In fact, even apply for your financing right there all through mobile, and even upload documents. Now, we have some fantastic partnerships, not only just with USC, but with other universities across the country, and our partnerships keep on growing throughout the year. So if you have a friend, family member, coworker that maybe attended these other universities, not only can they attend one of our home buyer workshops, but also be able to contribute in some of our discount programs that we have available, including the $750 closing cost discount, and have access to our free consultations and kind of what we do to help build home buying plans for our clients. Here's all my contact information. So if you do have some follow-up questions, or you want to message me after tonight's discussion, we'd love to be able to connect with you. And check us out on some of our social channels. We're going to be posting updates, including what's coming ahead on the California Dream for All program. Being part of the team that's helped building that program, I'm trying to share as much information with our local communities that I'm getting, so you can kind of prepare if you do want to add that as a resource for you in home buying. And we love what our clients are saying about us on our Google and Yelp reviews. A lot of our clients that have attended classes like this over the last 6 or 7 years, really proud of some of the testimonials that we have there. And again, if you do want to schedule some time with us, please feel free to use that schedule appointment link there. Other than that, that's basically what we have for you in tonight's class. We're going to go and keep the lines open in case there is any questions that we can address here, and then we'll go ahead and sign off if we don't have any questions. So I'll go ahead and keep the lines open, and then we'll go from there.